Namaskar, hello and welcome friends to Finnovision, your one-stop solution for CFA exams. My name is Shushmit Aditya Mukherjee. I'm an educator and an investment research analyst, and this video is part of the full class series for CFA Level 3 curriculum. Hope you enjoyed this video. Let's get started.
Index-based equity strategies. Hello and welcome friends to this new chapter of CFA Level 3. This is first chapter of the CFA portfolio management pathway. So this is the first chapter on this traditional pathway segment, and this is part of the first chapter of volume 1. We are going to discuss all the segments that are included in this chapter here. So let's get started. So friends, when we are trying to create a portfolio, there are many ways to do that. One can try to create a customized portfolio where everything is designed from ground up based on some basic idea which can be proprietary or some unique idea. It can be based on some benchmark, which is basically loosely tracking a benchmark but keeping the original strategy in place. That means a reference frame will be there, but the strategy will be quite independent in terms of both risk and return objectives. Then there can be strategies which are following the benchmark to a much greater extent, but they are still deviating in certain ways, strategically also, not only tactically, they are deviating strategically also, but they are very, very close to the index or the benchmark, right? And a third strategy can be there, which is trying to exactly track a benchmark. Now, this benchmark that the portfolio is tracking loosely or very, very closely, or just keeping it as a comparative measure, this benchmark can be customized benchmark, which is built just to track the portfolio's performance, or it can be a default index which is already there. Like for India, it can be Sensex, it can be Nifty Banking, it can be Nifty Small Cap, Mid Cap, Large Cap, it can be S&P 500, it can be the Dow Jones, it can be the S&P Small Cap, it can be the Dow Jones, it can be some sectoral index, it can be some global index, and such. N number of indexes can work as the benchmark. And most of the times what happens is fund managers find it easier to communicate and also to track something which is already there, which is transparent and there for everybody to see. And this benchmark, obviously, as we have said, is the index. Many kinds of index that are already there in the markets can be used as benchmark. And when a portfolio is closely tracking, very, very closely tracking that particular index, we are then actually looking at index-based equity strategies. Index-based equity strategies or index-based portfolio strategies. Now, why should one closely track an index, something which is already there? Let's understand the reasons. So the first and foremost reason can be low cost. The first and foremost reason can be low cost. Like creating a customized index or creating an IP or creating an original idea may take time, may be highly risky, may be highly costly. So index-based strategy provides a very, very low cost comparative option. Then there is diversification. Now, based on how the index is chosen, it can control the different degrees of diversification. Now, a portfolio may be tracking a small cap index that will make it concentrated in the small cap segment. It can be tracking a mid cap segment that will make the portfolio a mid cap oriented portfolio. It can track a large cap index, then it will be called a large cap or a blue chip kind of a portfolio. And it can also be flexi cap or multi cap, in which case multiple scales of market caps will be required, or a diversified index will be required. So diversification can be done, and the degrees of diversification can be controlled by choosing the index. Then there is tax efficiency. Now, why is an index-based strategy tax efficient? Because when we are tracking an index, it generally has low turnover. Let me write it down. Then there is no active trading going on in a major way, right? Now, moreover, index-based strategies include index-based ETFs, which support in-kind transactions. That is, there is no redemption of stock for cash. So there is no capital gains involved in that. So all these reasons combined, index-based strategies can turn out to be tax efficient in a comparative way to a significant degree. Then obviously there is transparency. Indexes which are used as benchmark are generally having transparent rules of their constituents. Why they are there? What are the conditions for them to be there? What are the conditions for new entrants to be there? And what are the conditions that existing constituents may be replaced? So all these things are transparent, which makes index-based strategy a very, very transparent strategy in itself. Now, how can an index-based strategy be turned into a portfolio? There are basically two ways in which this can be done. One is market cap weighing and another is factor-based weighing. Market cap weighing of the portfolio and factor-based weighing of the portfolio. What is market cap weighing? When the index is market cap weight, that is the proportions of the market cap decide how much of a constituent will be there in the index, then obviously this is called a market cap weight index. So let's say there are three companies. One is having a market cap of $2 billion, one is having a market cap of $3 billion, and one is having a market cap of $1 billion, right? These are figures in millions, let's say, right? Now, in a market cap weight index, the constituent proportions will be 2:3:1, right? If this is the way the weighing is done, then obviously we call it a market cap weight policy of construction of index, and thereby if a portfolio is following this kind of an index, that also should be ideally market cap weight, right? Then what is a factor based index? A factor based index is basically tracking one or more factor. So it is either a single factor based strategy or a multi-factor based strategy. Now examples of single factor based strategy can be based on CAPM, right, which is only tracking one factor, which is the risk premium compared to the markets. It is directly not tracking anything other than the market risk premium, but indirectly, depending on the stock selection, depending on the market cap selection, depending on some other parameters, this can happen to have higher risk exposure to some other kinds of risks, right? Higher risk exposure. Now, an alternate for this factor-based strategy is the multi-factor-based strategy. So what do we mean by a multi-factor-based strategy? So multi-factor means it is not only taking into account the market risk, it is also taking into account the valuation. It is also taking into account the growth factor. It is also taking into account the size of the company, the yield of the company in terms of it can be dividend yield, the momentum of the company, which means the price performance in the past of the company, the quality of the company. Quality can be in many ways. It can be in terms of the management, it can be in terms of governance, it can be in terms of business efficiency, it can be in terms of scale, it can be in terms of brand equity, etc., etc. Then volatility, right? Compared to the market or compared to the risk-free rate, how much volatile is the pricing? So all these factors or any combination of these factors, if they are used, the number of factors has to be more than one. In that case, this strategy will be called a multi-factor based strategy. So an index may be tracking only one factor, or it can be tracking multiple factors. When we create a portfolio based on an index or a benchmark which is tracking multiple factors, then it will be called a multi-factor based strategy. When we are trying to track only one factor, it will be called a single factor based strategy, right? One of the very popular multi-factor models is the Fama French 5-factor model, right? So this uses 5 different factors. The first one is the CAPM, that is the market risk premium factor. Then the valuation factor, which is the book to market ratio. The higher the positive sensitivity of a portfolio is to this factor, the greater value orientation this has. Then there is size factor. Fama French has a small cap orientation. So a positive sensitivity and a high value of sensitivity generally means that it is small cap, the portfolio or the strategy is small cap oriented. Then operating profitability, and then investment intensity. The operating profitability is the measure of a company's robustness or its weakness. And the investment intensity is basically the degree to which capital is being spent on increasing the volume of the assets of a company. So these factors form a 5-factor model which is called the Fama French model. Now what if a portfolio is trying to extract more efficiency or more return out of a market? Maybe it is tracking a benchmark or an index, but it wants to gain more through some strategy or some tactic. Now there are two ways mainly of doing it. One is a smart beta method. A smart beta method is basically changing the factor sensitivity. Let's say the size factor sensitivity of a benchmark or an index is 0.5, right? 0.5. Now a portfolio decides to have a size factor sensitivity of 1.0, right? This is the size factor sensitivity. Now the portfolio has higher sensitivity to the size, which means it is more small cap oriented than the benchmark it is tracking. So there is a tilt in the factor. And because the premise is basically the same, the cost remains comparatively low than active kind of strategies, right? So there is a tilt and the cost is also low. And we are not seeking alpha here. Please remember, we are not seeking alpha here. We are seeking a change in the factor sensitivity or the beta sensitivity. So this kind of a portfolio is called a smart beta. Now apart from that, there can also be a degree of active management in the index. Now what do we mean by active management? We are obviously not talking about actively managed portfolios here. We are talking about active management upfront in an index-based design. So when the portfolio itself is being created or the strategy itself is being created, there are certain decision-based deviations being done, right? There are certain deviations which are being done in the portfolio design from the index. These are done upfront. This is not a strategy this is not an active strategy, by the way. This is an upfront tilt or upfront movement from the regular formation of the benchmark that it is tracking. So there is an upfront deviation from the index, right? And there are tactical timing deviations also. Plus there can be factor tilts also. Factor sensitivity tilts also can be there. So if these three are combined, we say that it is an index-based strategy which is following the active management pattern. Actively managed funds are not the same as actively managed index funds. In actively managed index funds, the index is the starting reference point. Then we decide what are the deviations, what are the degrees of the deviations, and what are the tactical timing strategies and factor strategies that are going to be taken. The decisions are taken, much of the decisions are taken upfront, and then there are tactical tilts only that are being done. But in case of an actively managed portfolio, which is not index based, the starting point may not even be a benchmark or an index. The starting point may be an idea or a strategy or a proprietary strategy itself, right? So there is a basic difference here, and the risks will be much higher in terms of both idiosyncratic risk or systematic risk in case of an actively managed portfolio. In case of an actively managed index-based portfolio, the risks are much lesser. The starting point is an index, the tilts are lesser, and much of the decisions are being taken upfront with the barometer or with the comparison being with that of an index. So this is a basic difference here. And smart beta is basically a special case or an example of active management only. Now, like transparency is an advantage for index-based strategies, there are also certain risks to transparency. So here we discuss what are the risks of transparency, right? The obvious risk is replication of the strategy. Because the index is available in a transparent manner, multiple replications are possible, which may lead to overcrowding of this strategy. And this may ultimately lead to less realized returns or overvaluation also. Right? Replication, which means overcrowding, which means less realized returns because overvaluation or extreme levels of efficiency, right? Now friends, why should we focus on factor-based strategies when we already have market-based strategies or market-weighted indexes freely available, very readily available? The reason is factor-based strategy try to get more returns or risk-adjusted returns in terms of their portfolio allocations. And based on this basic premise, many kinds of strategies can be designed. The strategies can be return oriented, they can be risk oriented, they can be diversification oriented in case of factor based strategies. Now let us discuss a return oriented factor based strategy. A return oriented factor based strategy. Now this return orientation can come out of measurements of yield. It can be the absolute dividend yield or the dividend yield growth rate or the projected dividend yield, right? Then comes momentum factor. In terms of momentum, the factor can be what has been the return in past 6 months or 12 months. Now, this portfolio, if it is having a negative sensitivity to the momentum factor, that portfolio will be called a contrarian portfolio, right? And a positive sensitivity means it is following the momentum strategy itself. The third return orientation can be based on fundamentals. What is the return on capital? What is the debt scenario? What is the quality of the management, quality of the governance? What is the brand of the company? How satisfied are the customers? All these qualitative aspects and also the financial aspects are taken into account when constructing a fundamentals based return oriented factor based strategy. Then we can talk about risk oriented factor based strategies. Now they can be solely based on the measurements of absolute volatility or downside volatility. Risk oriented factor based strategies can solely focus on the volatility reduction factor. That is, they can either focus on reducing the absolute volatility or the downside volatility. This can be one way. The other way can be maximize expected return in terms of the risk. This is called minimum variance investing. Minimum variance investing, and this requires a mean variance optimizer program. What this does is it corresponds the returns with the level of risk and then tries to minimize the volatility for a certain level of return, certain level of target return, right? Which can be decided by the investor or by the index or by the benchmark. Now, the main difference between volatility based and mean variance optimizer based programs is that in mean variance optimization, we are also taking into account the returns. When we are talking about volatility based strategies, we are not taking into account the returns. We are only focused either on the absolute volatility reduction or the downside volatility reduction. This is the main difference. Now, one of the main drawbacks of this is this kind of orientation requires past data simulation. And the past data of volatility may not correspond or exactly match with the future data, right? The third kind of orientation is diversification based orientation of factor based strategies. These can be of two types. One is equally weighted portfolio. So let's say we are trying to create a diversified portfolio which has large cap stocks, mid cap stocks, and small cap stocks. Now, instead of market cap weighing them, if we weigh them equally, this means that the total assets under management, that is the total AUM, will be divided into three equal portions. 1/3 for the large caps, 1/3 for the mid caps, and 1/3 for the small caps. Now let's say the AUM is 300 million. In that case, 100 million goes to large caps, 100 million goes to mid caps, and 100 million goes to small caps. In this way, what we are doing is we are actually giving a large amount of significance to the small caps and also a large significance to the mid cap stocks, which may not be the case if we try to weigh it in terms of market caps. If we weigh it in terms of market caps, maybe 60% or 70% of the weightage may be taken over by the large caps. Let's say in an index there are n number of stocks. In an index there are n number of stocks. Now, if we are considering an equally weighted diversified strategy, then each of the stocks will have a weight of 1 by n. Right? Each of the stocks will have a weight of 1 by n in the portfolio. That means if it's a 100 million portfolio and there are 10 stocks, then each of the stocks will get 10 million in the allocation. This means irrespective of if it is a large cap or a small cap, it will get equal amount of allocation, which in turn results in diversification. The other strategy is maximum diversification strategy. Now, maximum diversification is basically a measure which is derived from the diversification ratio. Now, what is the diversification ratio? The diversification ratio or DR of an index I is given by the sum of the weighted volatilities of the constituent stocks of that index divided by the volatility of that index itself. Right? This is the diversification ratio. And the objective of a maximum diversification strategy is to maximize this number. So in the maximum diversification strategy, we are trying to maximize the diversification ratio. Advantages and disadvantages of factor-based strategies. First, let us talk about the advantages. The first advantage can be better performance. Because of the factor orientations and the awareness of the factors that are being targeted, if they are targeted properly, then this can result in better performance. Active return benefits or active return and risk diversification benefits. In a factor-based strategy, the factors are being taken into consideration and allocation to them are being considered both in terms of risk and returns. So there are active benefits there. Then factor rotation. Depending on the stage of a business cycle, different factors may become more return giving. That means, let's say, when a market is going through a contraction cycle or a business cycle is in a contraction phase, contrarian investing can become very much beneficial. On the other hand, at the inception of a growth cycle or an expansion phase, growth investment can be beneficial. So this means changing the factor emphasis can result in higher returns and better performance. Now we'll talk about a few disadvantages. Higher fees. Obviously, setting up factor-based strategies requires higher costs in terms of resources, higher commission. Because there is active strategy involved here, higher commissions can also be interns involved. Higher tracking error. Now, one thing is positive tracking error, that can be a good thing. But if it is a negative tracking error which is of high value, that means the factors which were being thought to be rewarding did not reward in the proportion that had been projected. So this can be a possible consequence of factor-based strategy. Now friends, pooled investments. Pooled investments. What do we mean by pooled investments, friends? Let's say a fund manager creates a corpus which is worth 1 billion. And this 1 billion entire corpus had actually been collected from investors by giving them or distributing small units. Small units which basically represent a very small fraction of this entire corpus. But the advantage is, even the investors who want to invest small amounts, they can also participate in this large corpus which has access to investments to create portfolios the way they want, right? Now this portfolio creation may be based on index also. It can be based on active strategies also. It can be based on black box or hidden strategies also. In case of actively managed funds, it can be a strategy or an idea based on which investments are being made. That can also be there. Or it can simply track an index. In that case, this will be a pooled fund which is tracking an index. Now examples of this can be index-based ETFs. Index-based ETFs. Or mutual funds which represent large cap indexes, mutual funds which represent mid cap indexes, mutual funds which represent small cap indexes, or multi-cap mutual funds, or flexi-cap mutual funds. So these can be examples of pooled funds, which are basically a collection of small amounts of investments from multiple different investors. Now these units, small units which are distributed to the investors, may be called ETF units when it's an ETF, or it can be called mutual fund units when it is a mutual fund. Now how these ETFs and mutual funds operate, let us understand that. First, let us discuss how an ETF is created. So let's say a fund manager designs an ETF. A fund manager or an ETF provider designs the fund. How the portfolio is going to be, which index it is going to track, what is going to be the strategy, what is going to be the tactical deviation limits. All these things have been decided at this stage where the ETF provider has designed the fund, or the fund manager or the ETF provider has designed the fund. Then, once this designing has been done, authorized participants are contacted. Now, who are authorized participants? Authorized participants are large institutions who understand the design of the ETF, who understand what kind of corpus is needed, and based on that, they allocate their funds to invest in that ETF offering. So let's say the total corpus of the fund is 1 billion, and 10 authorized participants invest 100 million each. Now, where do they invest? Do they give the money to the fund manager? Not exactly. Based on the design of the funds, what the authorized participants do is they go to the stock markets. They go to the stock markets and they buy up the stocks based on the ETF design, right? They buy up the stocks based on the ETF design, and what they do is they give it to the ETF provider or the fund manager of the ETF. ETF provider has invited the authorized participants to participate in it, and depending on the corpus and the design, they buy up the stocks, and then what they do is a transaction occurs. What is the transaction? The authorized participants deliver the shares to the ETF provider. Deliver the shares to the ETF provider. They deliver the shares. See here, we have written shares are delivered from the authorized participants to the ETF provider, right? And once all these shares are accumulated, an ETF is created, a total exchange traded fund is created, and this entire fund is divided into small units called ETF units. These ETF units are handed over to the authorized participants in return by the ETF provider or the designer of the ETF, right? Now, what does the authorized participant do with this ETF? The authorized participants list these ETFs on the stock exchange. They list these ETF units on the stock exchange. Now, once these ETFs are listed, then in the secondary market, that is in the stock exchange, other investors can invest in these units through buying and selling in the stock exchange. So the first round of buying is actually happening in the stock exchange, and then within the stock exchange, buyers or sellers are changing hands through purchase and sale of the ETFs, right? So here, the direct transaction is not between the ETF manager and the investors. Here, the direct transaction is actually between the investors and the authorized participants. The investors and the authorized participants. The transaction actually happens between them, right? So when the investor is buying the ETF, they are actually buying from the authorized participant. They are actually buying from the authorized participant. And when they are selling it, they are again selling it to the authorized participant, because the authorized participant has listed the ETFs in the stock exchange. Now, once the listing has happened, there is a demand supply game which goes on. Now, what do we mean by demand supply game? The ETF was designed, it was funded, or the stocks were purchased and delivered to the ETF provider by the authorized participants. The authorized participant in return got the ETF units which they listed in the stock exchange. And in the stock exchange, now there is a demand supply equation going on between the investors and the authorized participants, right? Now, if the demand of the investors is more, what the authorized participant does is they buy more stocks and they hand it over to the ETF provider, and the ETF provider provides more ETF units. But if the demand falls, that is, if the selling in the stock exchange is much more of the ETF units than the buying, then the authorized participants is left with no choice than to sell the underlying stocks and give back the ETF units. Then the authorized participants have no other choice than to return back these excess sold ETF units back to the ETF provider, and the ETF provider in return returns back the stocks to the authorized participant. And this is how transaction goes on. And this kind of transaction between the authorized participant and the ETF provider is called in-kind transaction. In-kind transaction, right? In-kind transaction. Why in-kind? Because the ETFs are being exchanged for stocks. There is no exchange of cash here. The authorized participant is holding the ETF, If the ETF is being sold much more in the markets, then the ETF is returned to the ETF provider by the authorized participants, and in exchange, they take back the stocks to themselves. The stocks they had given to the ETF provider, they take it back. So there's an in-kind transaction that is going on. And because of this, ETFs tend to be much more tax efficient, right? Because there is no selling of stocks going on here. So therefore, the question of capital gains tax, short term and long term, arises much less in this case, is avoided in this case, right? Now, we will talk about closed-end and open-end mutual funds and how they are different from ETFs. Let's understand that. Let me remove a bit of the rough work here. First, let us discuss how an open-end fund is created. The first step is the fund is set up. That is the benchmark or the benchmark index, the strategy, the tactics, the fund manager, everything is settled first. The fund is set up. Then the investors' capital is pooled. Obviously, marketing is a part of this. The marketing and distribution and all this thing is a part of it. And the investors' capital is pooled in a preliminary way, right? Now, after that, the fund is initiated. Fund is initiated means investments are happening in the form of units purchased. Now, how is the capital pooled? Obviously, by distributing units of the mutual fund. Investments happen in the form of units purchased. The investors get units in exchange for cash invested, and that unit has a particular NAV or net asset value, which depends on the underlying portfolio of stocks that this cash is going to be invested in, right? Now, once the fund is initiated, once this fund is initiated and capital is taken from the investors by distributing units of mutual funds, which has particular NAVs, from then on, the fund does not become closed to other investors. New investors can also invest in an open-ended fund. Initially, the fund was of a size $1 billion. $1 billion was collected initially from the investors, and the fund was initiated through that. But even after that, new investors can invest in this fund. Somebody wants to invest, let's say, $100 million here. That investor, he or she, can invest here. And in that way, the total AUM of the fund increases. And how does this happen? New investor provides cash to the fund. That cash is used by the fund. That cash is used by the fund to buy stocks, actual underlying stocks based on the information document, right? And in this way, the fund size increases. On the other hand, the stocks remain with the funds and units of the mutual fund are given to the new investor, right? In exchange of the cash, the fund purchases stocks and they keep the stock with themselves. They convert that value into units of the mutual fund and they give that unit or those units to the new investor, right? This is how the transaction ensues, and any number of new investors can enter into it depending on various conditions, market situations, funds decisions, etc., right? Investors can also redeem. So we are talking about the investors entering, right? Next, let us talk about how can investors redeem. At any time, investors can redeem. So when an investor wants to redeem, that investor basically returns the units to the fund. And the fund takes the units, they sell the stocks, the underlying stocks are sold in the stock markets, and there is generation of cash. This cash is taken and returned back to the investors, right? Whatever returns are there, whatever exit loads are there, that depends on the conditions. But this is how basic operation happens. The investor returns the unit to the fund returns the underlying stocks or sells the underlying stocks in the stock market, cash is generated, that cash is handed over to the investors in return. Now this redemption process obviously has certain situations, drawbacks in terms of tax exposure. So when the stocks are being sold, what happens is capital gains taxes are being paid. So when the stocks are So when the stocks are sold, capital gains tax are being paid, right? And this tax actually takes a toll on the performance, impacts the performance. So this is a key difference between ETFs and mutual funds. Now, we'll talk about it a little bit more in the end of the section, but first let us talk about closed-end funds, how these funds work. So again, the funds are set up, the strategy, the benchmark, the team, the fund managers, everything is set up, right? Then the initial fund offering is done. So like the stocks, in case of closed-end fund also, closed-end mutual fund also, the initial offering is called initial public offering, right? Now, in this initial public offering, investors are allotted units. They are allotted units in exchange for their investments, and these units gets listed in the exchange thereafter. Now, once the listing has happened, trading can take place in the secondary market between investors, right? Just like stocks, once the listing has happened, trading can take place between the investors. Here also the same thing is happening. But one thing which is slightly different here is capital gains and income distribution happens periodically. So whatever earnings happen through dividends, etc., are given back, and whatever capital gains is earned through selling of stocks is also distributed back to the investors. This is one of the factors, but this also has tax implications. Just like open-end funds, this also incurs taxation, right? So in terms of tax efficiency, ETFs are much more tax efficient than both closed-end and open-end fund. So here we have written a few advantages of ETFs. First is tax efficiency. Lower turnover of stocks. Obviously, the transaction of stocks is happening in kind. ETFs are being exchanged between the authorized participants and the ETF provider. ETFs and stocks are being exchanged in kind between them. So, turnover of stocks is much less. Liquidity of ETFs is very, very high. ETFs are quite liquid because they are like closed-end funds or like the stocks, they are listed in the markets. Because of less taxations, less turnover, etc., high liquidity, the performance is higher for an ETF. Now let us move into the next section. Use of derivatives. So use of derivatives in portfolio management has certain advantage, friends. Firstly, without changing the basic structure or composition of the portfolio, certain overlays can be added which can actually result in the targeted constitution. So what we are trying to say is, let's say there is some proportion of bond or equity which is off the mark just a little bit, and the portfolio manager does not want to change the composition as of now because of the market situations, but they aim to make the composition as per the mandate. For that, derivatives can be used, right? It's just an example I'm taking. Now, what are the kinds of derivatives that are used to do these kind of modifications into the portfolio without changing the basic structure, right? So, the derivatives that can be used are index futures, index options, and equity index swaps. So, any kind of portfolio which is benchmarked to a particular index, that index might be having its own futures and its own options. They are also listed in the exchanges. If somebody wants to create a customized derivative, one option is creating an equity index swap. On the other hand, if someone is looking to create a customized index swap, equity index swap, then that can also be done. Now, why are these derivatives used within a portfolio? I have just given an example. Now we will discuss briefly the reasons for which these derivatives can be used in a portfolio. Purpose of using futures or options or swaps or basically derivatives in a portfolio management structure. First reason is completion. Now, whenever we are using derivatives to modify a portfolio without changing the basic structure or the underlying structure, that kind of a process is called overlay, right? So here the purpose is associated with the term overlay all the time in all the options. Rebalancing overlay is there, currency overlay is there, and obviously completion overlay is there. We'll understand one by one all of these terms. So as we are speaking about completion overlay is generally needed when a portfolio, say, is having surplus cash. Surplus cash means the beta of the portfolio has been reduced. There has been reduced beta in the portfolio because the cash is risk free, right? So when you use more cash in the portfolio, or when there is more cash than required in the portfolio, the beta of the portfolio falls maybe beyond the required limits, beyond the required range. In that case, just to increase the beta of the portfolio, derivatives can be used. So this is one of the purposes of using derivatives within a portfolio management system. Then, rebalancing overlay. As we are saying, let's say the bond percentage and the equity percentage have drifted from the strategy, right? And the markets are such that the manager prefers not to directly enter the markets right away and change the portfolio. Let's say buying bond and selling equity, or selling bond and buying equity, either of these activities may not be suitable taking into account the current market scenarios. Then derivatives can be used. Not only because of the market scenarios, because of liquidity advantages, because of flexibility of derivatives, because of multiple factors, derivatives can be used instead of directly buying the underlying in the market. Then currency overlay. Increase or decrease of a certain currency exposure has happened within the portfolio, let's say, right? In that case also, currency overlays or currency derivatives, currency futures, currency options can be used to adjust that excess exposure, right? Now we spoke about derivatives. Now the question comes, when to use cash instruments directly. Cash instruments should be used directly when regulations on derivatives prohibit the direct use of derivatives. Then when the movement is actually a longer term strategic movement, it's not a temporary tactical movement, then the underlying can be directly adjusted instead of getting into derivatives. Then when there are risk and cost considerations, and those considerations weigh the option or weigh the choice in the favor of buying the underlying. This can also be the case, right? Because derivatives involve leverage. Derivatives involve customization in some cases when you are actually buying an OTC counter or like something like a swap. In such a case, risks can be involved, right? Like counterparty risk. So when the weighing is in favor of buying the underlying in terms of risk and cost, then also you choose the underlying instead of the derivative. Portfolio constraints. Let's say the portfolio mandates that derivatives cannot be used or cannot be used beyond a certain point. In that case also, direct cash investment has to be made, right? Now, advantages and risks of futures contracts. So we have spoken about futures, options and swaps, right? Now we'll talk about advantages and risks of futures contracts. So first let us look at the advantages. So first obvious advantage is liquidity. Derivatives are highly liquid instruments. Then leverage. Leverage can be used, which means less capital can be used to take comparatively larger positions. Compared to what? Compared to the capital requirement when we are trying to take a direct position in the underlying. Compared to that, the leverage that one gets because of the derivatives can be very, very advantageous in this case. Low bid-ask spread. Because of the liquidity, the bid-ask spread can be low. Low commission and execution costs. Obviously, liquidity is there, demand is there, availability is there. Therefore, low commissions and execution costs are just a consequence of that. So these are all the advantages of futures contracts and using futures contract within a portfolio. Now let us look at the risks or the disadvantages, possible disadvantages or risks. One obvious risk is there, which is called margin call. Means when the futures goes against the speculations or there is volatility in the futures contract, it can trigger margin call. Margin call means the margin amount that has been invested is not sufficient to cover the risk of the leverage. Therefore, more investment might be required. High volatility. Futures contract can be very volatile because of the liquidity, because of market scenarios, etc. etc. They can be much more volatile than the underlying in many cases. Advantages and risks of swap contracts. So the first advantage is it is customizable. Because swap is an OTC contract, it is highly customizable. More frequent settlements. Futures has a single expiry. Option may also have, especially if it's a European option, then it'll have one single time segment, right? But swaps are periodic payments. So there is one payment, then after a certain period there is another payment. After a certain period again there is another payment. Like this, the payments are distributed over a period of time, which actually also distributes the risk of the derivative. So this more frequent settlements is an advantage. Avoid capital gain tax partiality. The next advantage is avoids capital gains tax partially. Why this is so? Because positions are not sold directly. We are taking an overlay as a swap contract, and as such we are actually avoiding capital gains tax. Why partially? Because eventually the holdings may have to be sold or adjusted in the long run, which means capital gains tax will have to be incurred. Then leverage. The swap contract is based on a notional amount, right? So the notional amount is actually not invested, but based on that notional amount there is some transaction going on, and this gives a certain degree of leverage. So this is again another advantage. Now let's discuss the risks of swap contract. It's a OTC contract, which means there is counterparty risk. Lack of transparency. Because it is an OTC contract, because it is customizable, there can be lack of transparency. Liquidity can also be an issue. Tax implications. Swaps may be charged or may be taxed in the form of income. The returns from swaps may be charged in the form of incomes. Then, speculation can go wrong. Obviously, swaps one can enter based on certain speculations that certain interest rates are going up, certain valuations of stocks are going down. Based on all these assumptions, swaps are entered into. But if that speculation goes wrong, then obviously one has to pay for that. Separately managed equity index portfolios. So certain very high net worth individuals or institutions tend to use separately managed accounts because that can give a high degree of customization. Instead of investing in a pooled fund, they may prefer to invest through a manager only, but through a separately managed account. That obviously requires a particular minimum investment threshold to qualify for it, right? But certain investors or certain institutions do qualify for it and they do choose it. Now, how is a separately managed account operated? So first, an index is selected. Now, after selection of the index, obviously that index is going to act as the benchmark. So one needs to know the details of the weights and constituents that comprise that index. So for that, data subscription is required. Now generally that can be provided by the index provider itself, but it can also be purchased by a third party. Now what do they provide? They provide primarily the constituents and their weights. The constituents and their respective weights and the basis of those constituents and those weights, right? And also additional related information related to those constituents like price, dividends paid, corporate action related information, periodic reporting, quarterly reports, transcriptions, call transcriptions, annual reports, all those, right? Now, index is selected, the constituents and the information related to those constituents is acquired. Then comes the turn of choosing and designing trading systems, right? An electronic trading system has to be designed that is effective in terms of costs, and also it provides ease of trade. These are required. Now apart from that, the trading system also requires broker relations so that commissions can be negotiated, and for managing the transactions an accounting system is also required, right? Now all these things fall under the purview of a compliance mechanism because rules and regulations have to be complied upon. So a compliance mechanism is also required. Compliance mechanism. Trading in specific scripts may be restricted or limited, right? Then there can be limits on overdrafts that can be stipulated by the regulation itself. Then conflicting activities like front running by the manager, that also needs to be avoided. There has to be an accountability of all these factors. These are some of the factors but not exhaustive. So because of all these reasons, compliance mechanisms are also required. So all these things put together comprise this separately managed portfolio management system. When a portfolio is being constructed, we have already spoken that there can be a benchmark which can be referenced. Now, that benchmark can be identically replicated. When it is identically replicated, the process is called full replication. It is called full replication. Instead of full replication, because let's say there are 3000 members or 3000 constituents in an index, which is the benchmark of a portfolio. In that case, the manager may choose to not select all of them within the portfolio because that can reduce liquidity, increase costs, increase inconvenience, etc. etc. Because of that, a little less or sampling. Because of that, stratified sampling can be done, which means based on sectors, based on sizes, based on fundamentals, stratified segments can be created, or different segments or sectors can be created, and from each of those segments certain representative stocks can be selected to comprise the portfolio. That kind of process is called stratified sampling. Then comes optimization. Optimization is basically fine-tuning a certain criteria. It can be maximizing the Sharpe ratio, it can be minimizing the variance, it can be optimizing the mean variance, it can be minimizing the tracking error, etc. etc. Then when we mix up one or more processes which are explained above, the process is called blended approach. Now we'll look at each of these processes in a little bit more detail. So first we'll discuss the full replication. How is a full replication done? Obviously, first the index is selected, which is going to be the benchmark for the portfolio. Then the constituents are known. The constituents and their weights, they are known. The constituents and their weights, they are known. Then replication is attempted as closely as possible, or preferably fully. So this is as simple as that. Now to do this full replication, obviously the manager needs to know how the trades have to be taken, or how much trades of what constituents in what degrees have to be taken to match the constituents and the respective weights of the index. That is done through an order management system, right? Now this order management system can be internally created, or the provided data can be imported into a data compiler like Charles River or Moxie. Either these kind of data compilers can be used, or some other internally created order management system can be used. Now, while organizing the order management system, the compliance and the constraints have to be programmed into it, right? So that compliance is not breached and the mandates are also maintained, right? Now, let's say an index has 10 constituents and another index has 1000 constituents. Which one is easier to replicate? Which one is easier to replicate, friends? Obviously, the one which has 10 constituents. And for the 1000 constituents, chances are that this is a diversified index, right? This is a diversified index. So this may have large caps or mega caps, then mid caps, and this can also have small caps, which means the more one tries to be accurate about replicating this index, the more illiquid territory one moves into, right? Like the small cap territory. This can be the possible case. So this kind of a situation creates a trade-off. What kind of trade-off? The trade-off between replication or minimization of tracking error and trading costs. So tracking error gets reduced more and more and more the more accurately you replicate. But if the index constituents are huge in number, then that also entails rise in costs. Now this rise in costs is represented by this orange dotted line. See, the costs are rising, rising and rising as one moves into the illiquid territory or illiquid domain of stocks. Right? One may be done with the mega caps, the large caps and the mid caps, but let's say in the small caps, the trading cost can be comparatively higher. In that case, what happens is the trading costs go up. But parallelly what is happening is the tracking error is coming down, which is shown by the green dotted line. But there has to be a trade-off so that the entire cost is minimized. The total cost has to be minimized. Let's say that is represented by the intersection point. Let's say that is represented by this point here, right? Now, this is going to be the trade-off point where the number of stocks is compromised so that the trading costs don't go up. And the sum total cost is represented by this white line. The minimum point obviously comes somewhere here. So this is the trade-off region where the number of stocks is compromised at a certain point so that the trading costs don't go beyond the point which actually impacts the performance. Now we will move into stratified sampling strategy. Stratified sampling, how this is done? Again, the process begins in the similar way. That is, we select the index, then we know the constituents, then we understand their weightages, the weightages of the constituents, what is the method and what are the weights. But let's say that index has 3000 constituents or 1000 constituents and the manager does not want to replicate it fully because that can entail high amount of costs and higher management costs also, right? So what the manager does is the manager does subgroupings, divides the constituents into subgroupings. Now that subgrouping can happen in multiple ways. If it's a bond portfolio, the subgrouping can be based on government bonds, investment grade bonds, high yield bonds, or it can be subgrouped in terms of credit quality, or it can be subgrouped in terms of tenure or maturity period, or it can be a combination of multiple of these factors, right? This is in the case of bonds. In case of equities, it can be small cap, mid cap and large cap. The stocks can be also divided into value and growth. The stocks can also be geographically divided into developed markets and emerging markets. And it can be a combination of multiple of these factors. In this way, subgroupings can be done. And after the subgroupings are done, a representative proportion of the stocks in each subgroup are taken to create the portfolio. This kind of a process is called stratified sampling. And the next step is to monitor and rebalance so that the representativeness is preserved in the stratified sampling strategy, right? Next comes optimization method. What is optimization? We have already spoken that optimization can be targeting or fine-tuning a specific factor. Now, for example, it can be minimization of variance, it can be maximizing of return based on minimized variance. Now, it starts again in a similar way. We select the index, we know the constituents, and we know their weights. Here we may know their weights or their respective variances or standard deviations, etc. etc. Then select the criteria or the constraint to be fine-tuned. Select the criteria or the constraint to be fine-tuned. Now what can be that constraint or that criteria? It can be variance. So for example, one can try to minimize the variance. This can be one of the target criteria, right? Then it can be maximizing return based on minimum variance. So first the minimum variance is measured and based on that the maximum return portfolio is created. That can also be another optimization technique. One more optimization technique can be maximization of the Sharpe ratio. Now, in this kind of a portfolio, there can be added constraints. Now, those added constraints can be multivarious depending on the strategy or depending on the investor's choice. Let me take a few examples. Let's say these kind of added constraints can be like concentration constraint. For example, one single stock selection cannot be more than 5% of the entire portfolio. That means minimum 20 stocks must be there in the entire portfolio. This can be one constraint. Then, leverage constraint. Leverage can be maximum 5% of the total asset value. So let's say it's a $100 million portfolio that the manager is managing. Leverage in that can only be 5 million. It can be done through shorting of stocks. It can be done through taking leverage directly, taking loans directly for some reason, to buy stocks, to buy derivatives, etc. etc. It can be to buy derivatives, that can itself be the constraint. Or shorting a position may be avoided. That can also be a constraint, that one cannot short stocks in the portfolio. This can also be a constraint. Now, based on all these constraints and based on the target criteria, the optimization tools are deployed. And then the weights are taken out. Now, based on these target criteria and applied constraints, the weights need to be figured out. For that, we need the optimization tools. Now, what are these optimization tools? A few examples can be CVXPy. It is based on Python. Then another example can be Excel solver. Using these kind of tools, the weights are figured out. What will be the weights of the constituents within the portfolio? These are called optimization tools, right? Now, after the weights are figured out and the constituents are also figured out, then comes the turn for constructing the portfolio. Constructing the portfolio means one purchases the constituents based on those solved weights. And once the portfolio is constructed, then comes the turn of periodic monitoring and rebalancing. Periodic monitoring and rebalancing. So this is about the optimization technique. Then what if we try to mix and match more than one of these techniques? Then the process is called blended approach. Blended approach means we are trying to mix and match the techniques to create a portfolio. Let me take an example here. Let's say one chooses a diversified index. Let's say that index is Russell 300 or that index is Nifty Total Market. Now this kind of index may contain large caps or mega caps, mid caps and small caps, all three kinds of stocks. Now for different segments of the index, different strategies are used. For example, for the large cap segment, full replication is used, and for the small cap segment, stratified sampling is used. Now this is combination of two methods to create a single portfolio. Why this is being chosen? Because in case of small caps, liquidity can be a constraint, market impact of trades itself can be a constraint, right? So based on that, we choose stratified sampling for small caps, and for large caps, because of high liquidity, we use full replication. Tracking error and excess returns. So friends, tracking error and excess returns are very important metrics when we are talking about index-based funds. Now, what is an excess return? Excess return is basically the return of the portfolio minus the return of the benchmark. The return of the portfolio minus the return of the benchmark. It is as simple as that. And the variance of this value across time, if you root over that, what you get is the tracking error. So it is basically the standard deviation of the excess return. Tracking error is the standard deviation of the excess return. Index-based mandates. In index-based mandates, obviously the goal is to minimize tracking error. Generally speaking, that is the primary goal, minimize tracking error. The mandate is to replicate the index as closely as possible, generally speaking. Avoid negative excess return, that is also a criterion. If there is a tracking error, it better be positive rather than negative. That is also preferred, right? Now, what are the reasons for tracking error and what are their solutions? The first reason we have already discussed, it is large number of index constituents, right? Large number of index constituents. Let's say an index has 3000 constituents. And if a manager tries to replicate this index fully, that will incur costs at the small cap segment or the illiquid segment. this can create tracking error and in fact negative tracking error, right? Then to solve this, the manager may use stratified sampling, but that stratified sampling itself can reduce the costs, but it can deviate the portfolio's returns from the index itself. Now this can be positive or negative depending on the stock selection, but sampling can also result in tracking error, right? Then fees charged by funds. Management requires some costs, for that fees are charged, and that can result in negative performance or negative tracking error. Intraday trading. Now, the NAV of a fund is measured at the end of the day. If the stocks are bought and sold at the intraday prices, that can be different from the end of the closing prices of the same stocks. That can also create the tracking error. Brokerage commissions is another reason, obviously, which can create tracking error. Then cash holding or cash drag. If there is more than required cash, that can also reduce the beta and also create tracking error for the portfolio. Now, what are the solutions for this? For the first, that is when there are large number of index constituents, you either use a stratified sampling approach or you use a blended approach, right? This can be a solution. For sampling, what can be the solution for sampling which results in tracking error? Try to replicate as closely as possible without compromising the performance, right? And if the mandate itself stipulates that it's a stratified sampling strategy which allows for some tracking error due to sampling, then that is okay. Fees charged by funds. This can be reduced by reducing the turnover, reducing the trading volumes, right? So, turnover has to be reduced. Then, intraday trading which results in tracking error. This can be solved by trading as close to end of day as possible. EOD trading. Broker commissions, obviously this can be solved by choosing the right broker and negotiating. Then cash holding and cash drag. This can be solved by minimizing the cash holding and also by using derivatives. Return and risk attribution for index-based strategies. Now friends, returns and risks both have their groupings. For example, the grouping can be company specific, the grouping can be sector based, the grouping can be country based, the grouping can be currency exposure based, and these groupings remain quite similar for both actively managed and index funds, right? These groupings remain more or less the same, but there can be certain specific objectives also, like there can be a dividend yield mandate. In that case, the index may have to be rearranged. A little bit of customization may have to be done of rearrangement where the highest dividend yield stocks are selected from a broader index, and those highest dividend yield stocks are used as the benchmark from that index, right? Then there can be a growth stock mandate. In that case, again, the index, a broader index, can be arranged in terms of highest growth stocks, and then a certain number of those highest growth stocks act as the benchmark. There also can be factor based mandates. In that case, the factor exposures of the constituents of an index are taken, and based on the intensity of the factor exposures, the benchmark is created and the portfolio is compared to that. So this is how risk and return attribution in an overall way is done. Now, is investor activism a very prevalent thing in index-based fund management? Let us ask this question. First of all, activism requires some cost considerations because there are legalities, litigations, regulations, mandates, votings, board representations, media campaigns. All these things are involved in investor activism, like activism kind of investing. That has costs. Now, index-based funds try to reduce or minimize costs. So, one has to do a trade-off that what is a better proposition. And one also has to consider, is activism going to result actually in a better performance? Activism for better performance is recommended. Activism for better performance is recommended, but one has to look at the trade-off. And one more thing is there, that index-based mandates are about following or replicating the constituents. not about changing the management structure or changing the strategy of companies. It is about following an index. So activism has to be questioned before pursuing it. That what are the costs? What are the implications? Will there be better performance? If there is better performance, what is the trade-off between the cost and the degree of better performance? All these things have to be considered when looking for a decision on activist investing. So friends, this is about it for this chapter. Thank you so much for being with me for the whole class. See you in the next class.
Thank you so much friends for being with me till the end of this video. If you enjoyed this video, please like the video and subscribe to the channel for more such classes. Share your feedback in the comment section below and share this video with a friend who may find this helpful. For enrollment to practical application courses, internships, and CFA curriculum classes, check the description below. Till then, keep watching Finavision. See you in the next class.